Hey, good morning, everybody. This is Hartaj Singh with the Capital Compass newsletter, reporting in from the San Francisco Bay Area. This is following a series of conferences, biopharma company conferences, that kick off the year here in the San Francisco Bay Area. I'd previously written a note on this a couple of days ago. These are euphemistically called the JP Morgan conference, but there's about 3 or 4 other conferences around it. There's quite a few people in the thousands, a number of biopharma and other healthcare professionals and investors that come here and do hundreds, if not, probably close to 1,000 or more meetings over 4 days from Monday through Thursday of last week. And this leads to essentially a gauge for people like myself on the sentiment of the industry. And then depending on companies giving guidance or, for example, M&A happening, we also get a little bit more of a quantitative measure as to how folks are approaching our industry to begin. I've been going to JP Morgan for over 20 years, both as a hedge fund investor and then also as what's called a sell-side analyst for various investment banks where I was covering biotech companies. This is the first time I'm representing myself. It was actually a lot of fun. And the main reason for that was, not that I did not enjoy it previously, is that I actually got to focus more on things that are of interest to me. When you work for a corporation, you have to attend events or do things that maybe don't interest you. When you're working for yourself, you can go to those things and meet those people and organizations that really, really interest you. So let's just go over as a synopsis to my note on Saturday, which is more in depth, a synopsis of what the takeaways essentially, what I think are the takeaways from the JP Morgan set of conferences in San Francisco last week. I think it was actually very exciting for me to see all of the innovation happening in our industry. We will update investors more on this. And the innovation isn't just around therapeutics. It's also around regulatory innovation, manufacturing innovation. All of these things go towards making our sector sort of scale more. More and more smaller companies are being born. More and more of them are making it to commercial. And so you need regulatory innovation, you need manufacturing innovation, you need clinical trials innovation going on. And we'll be writing on this more. Of course, we will also be picking stocks for you and helping you think about which stocks might or might not work and giving you insight on the industry as a sector to invest in or trade around also. Last week started off for us in a very exciting manner with what's called CERSI, C-E-R-S-I. It is actually a Center for Regulatory Innovation at UCSF, University of California at San Francisco, and Stanford. UCSF is probably one of the premier medical institutions in this country and in the world. And they host this center, and it was fascinating to go and listen to regulatory professionals give their say. The current head of FDA and a lot of ex-heads of FDA and sub-heads of FDA were there. And I think the general takeaway there was that the Trump administration has the potential to be a net benefit to the FDA. I did not get a sense from a lot of the commentary there people are scared or worried about what's going to happen. They really do think that the folks that are being hired into various positions of authority at the FDA are professionals, and we will see some really innovative approaches potentially benefiting the FDA going forward. So let's see. The sentiment around the conference then Monday through Thursday, I think was fairly distributed. It was from positive to continuing negativity. I think the average, probably I would call it as cautious optimism is probably the best way to put it, which I think is actually a good place to be because, again, I remind people that our sector is the most highly shorted sector. The XBI is the most highly shorted ETF of the healthcare ETFs. So investors, hedge fund investors, continue to be very negative on biotech relative to the other areas of healthcare. And we'll be writing about on this more. I think there's some good reasons there. We've written on that previously, why biotech is struggling, and there's some headwinds against biotech. We wrote a note on that 2-3 weeks ago. Media stories really centered around M&A resurgence, falling interest rates, regulatory clarity, and all of this sort of driving what's called targeted M&A. So really companies looking to fill potential holes in their pipeline in the future, or what I call bolt-on acquisitions to larger companies. The lack of big deals was a little bit of a bummer, or maybe even more deals signed was a little bit of a bummer. But let's see, it's a long year. I expect potentially M&A to pick up, but let's see. With a lot of it has to do where interest rates go and some other macro issues. But again, cautious optimism is the reading here. I'll also say that with the idea that the biotech sector continues to be in the doldrums, the most highly shorted ETF off the healthcare ETFs. In this kind of environment, we think it's better to buy stocks. It's not a good idea to buy the entire sector. In fact, if anything, the sector might be amenable to hedging. Use it as a short position to hedge like long positions if you're an active trader. We've detailed this in a previous note whereby we think short-term opportunists and swing traders and market speculators can benefit around times of volatility when the biotech sector is under stress. We also have a preference on the long-only side, or if you want to buy stocks from the point of view of capital appreciation as opposed to capital depreciation. In that sense, as a long-only, a preference is for biotech companies with dependable legacy franchises where late-stage pipeline innovation, with late-stage pipeline innovation driving growth. So really Gilead and Vertex screen very well there. Think about what that means. HIV franchise at Gilead and oncology are growing, dependably growing, and on top of that, future HIV innovation will should make revenues and earnings grow even faster. And the same thing with Vertex. They have a very dependable cystic fibrosis franchise that keeps on growing in the mid to high single digits, and they're launching pipeline projects on top of that. We'll write about that more going forward. The obesity market continues to be under stress. Its two lead players, we believe, will see that stress from a stock perspective. But just remember, this is really all about expectations. People thought the obesity market, TAM, total accessible market, was going to be huge, and these two players were going to own a significant portion of that. I think the compression happening right now is more around the TAM. The total accessible market might not be as big as people think it is. Instead of tens of billions of dollars, it might be only 50, 60 billion dollars, which is actually still huge, one of the biggest markets potentially in biopharma. And we remind people that after these stocks, at some point they should become a buy. We'll write on this more because again, these are growth companies and their revenues and earnings will see some pretty good growth going forward. The other thing is on the small cap side for biotech, these companies are facing a lot of continued pressure around fundraising. And there's a risk-off atmosphere really, apparent on the small cap side. So in this case, we really look as a first screen at companies, we'll write about this more, that have a good capital runway. So in that sense, we're thinking about companies that have at least 2 years of cash under their belt. And that way, for what I call a more generalist long-only investor, that kind of a small cap opportunity actually becomes sort of interesting. Doesn't mean it's going to work. No stock is ever guaranteed to work, or meant to work. But I do think with small cap biotech, that cash runway is really important to keep an eye out on. Absolutely more than 4 quarters, ideally more than 8 quarters. And then again, for the larger biotech companies, in 2025, revenue and EPS guidance expectation management will be important. Companies can't overpromise and underdeliver. They have to underpromise and overdeliver. That's really the key for companies that are commercial in the biotech space. And if they keep on doing that, like we believe, like a Gilead and a Vertex can, then I think that these companies really will hold investors well. Investable themes tend to be around stock specific, around M&A, like for example, Insight, pipeline catalysts, companies like Opthea, Precigen, Inovio. We'll write on this more going forward, but I just want to highlight this as examples, potential examples of what an investable theme could look like. So again, thank you so much for watching. I hope this was useful. I'm really excited this year on continuing to write, hoping to write at least 1 newsletter and ideally 2, 3 more. We will keep on doing expert calls and other innovative stuff to help people understand our market, and those people that really understand our market well trade it better and hopefully trade it in a profitable setting. With that, signing off. Talk to you soon. Bye-bye.